Welcome to Views from the North, a Canadian rates and macro podcast. This week, I'm joined by Matt Baird, one of our Canadian fixed income salespeople who's in town visiting from Vancouver. This week's episode is titled Cross-Border Quarters. I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Matt, thank you for flying all the way in just to do this podcast. I know I'm the only reason you got on the plane for 5 hours and will fly back for 5 hours.
Yeah, no, I do like being in the presence of local celebrities. So
he went around, and he's not here now.
Yeah. No, I was happy that our friends at Air Canada gave me a 7-hour journey from Vancouver to get here. Yeah,
that's unfortunate.
Yeah,
sorry.
It's okay.
No comment. They're much nicer to me, but all right. Thank you for coming on. Next week is the Bank of Canada.
Yeah,
and the market is split effectively. Pricing is oscillating around 50-50 for 50 or 25.
Yep.
I have been, I would say, pretty outspoken on my view for 25 basis points in writing and otherwise for those who talk to me. The street seems to be lined up, and the street, I mean the other talking heads like me, seem to be lined up more on the 50 basis point side. The view on our desk is somewhat split. I think I've made a compelling enough case that people are kind of coming my way. We'll see what jobs do on Friday, because I will fully admit if they stink badly enough, then anything's possible. That could change the view. But what do you think? Where are you in this debate, and why are you where you are?
Yeah, I guess it won't make a very good podcast if I just say because I listen to smart people like you and you're in the 25 camp. So I know we probably want a bit more friction, but I am in the 25 camp. And I think, the premise of that is they've moved to neutral quite quickly, right? For good reason, based on weakening data. I mean, you and the team here have done a great job of pointing out some of the structural problems, like the continuing productivity issues, the output gap, and then obviously inflation coming down to target, the GDP per capita argument. These have all been things that have played nicely into a central bank that had kind of a predisposition to cut anyway. But they have moved quickly to get closer to what is neutral. I mean, the market has their terminal rate as defined by 2-year, 1 year, whatever pick your poison on that one, 90 basis points through the US. Right, which you could argue. I think it's sort of in the 265 area as I left my desk, maybe a bit higher.
We rallied a bit over the past while.
Yeah,
sure.
But right in that area. So the market's pricing them to get there. It's kind of their option to take it. Obviously, we don't get paid to say where the market is priced. We get paid to say whether that's right or not. I think it's a little bit aggressive, and we can talk a little bit about why that is. I think a lot of that's to do with the U.S. economy, and that's, you and Doug have done a good job of mentioning how that's changing the BOC's neutral rate, and has actually, from the lows, has brought it a bit higher. But I also just think that, at this point, they've done enough, and there's probably not a reason to rush here. I know there's a lot of people talking about their comments around not being concerned about the divergence from the overnight rate in the US, and that being a reason why they can continue to go quickly. I think that just means that they can continue to go, but they don't need to continue at the pace that they were on before. So it's more of a slowing of the pace. Path of least resistance is to continue cutting.
So the only thing that you said that I'll take the other side of there is that I get paid to prognosticate these things. I thought it was just to speak on this podcast. Yeah. I'm confused, and to write my giant thoughts on pieces of paper. But no, I think I'm with you mostly. And I guess where I differ from the 50 crowd is in October, the way they got to going 50, the way that they arrived at going 50 instead of 25 was entirely driven by the data. So you had inflation come in below expected. You had growth come in well below expected at a time when they're expecting it to accelerate. And that combination is not friendly for an inflation targeting central bank. Since October, we had inflation come in higher than expected and above what the MPR is forecasting. And growth on the soft side, admittedly, that is one thing where maybe you could make a bit of an argument, but it only missed by 0.5 percentage points annualized. So not annualized, that's about a tenth. And the level of GDP was revised up 1.5%. So 10 times the revision on the miss. Some of that revision will mean higher productive capacity because it was business investment, definitely. Nonetheless, there's no debating that the revision probably wipes away that GDP miss. At least I don't think there is. We won't really know that until the bank puts out their next MPR in January. But for me, it's just not that. It's not the type of miss to drive a 50 basis point move, especially if you consider that inflation was higher. And then on top of that, you have the federal government adding fiscal stimulus to the picture. And they were already expecting growth. The bank was already expecting growth to pick up in 2025. And so I think this pretty much locks in some seriously better numbers for the first quarter, at least. We'll see if the handouts come or not, from the federal government, at least, if those checks get mailed or passed in Parliament. But you have this new kind of upside to growth, even if it's short term. I think the bank's view would be that, okay, that is short term. Definitely, it'll last a quarter. I mean, we lifted our call for Q1, but their view is that if you look a little further out, and that just buys you some time for the rate cuts to have an impact.
Totally, and a couple other things just on that point around, I don't want to describe it as resilience in the Canadian economy.
Stubbornness is what I would call it.
Yeah, stubbornness is probably the best way to characterize it. I mean, I was just thinking. I was thinking about a couple of things on that front, right? Like you still have wages running at 5% plus, right? For maybe
I would say 3.5 to 4.5, depending on the metric you want to use. Only because like the bank put out that paper on the labor force survey wages that said they were too high. But even if you cut them down 1%, it's still like 3.5-ish.
Right.
So it's still pretty high.
So wages are still running relatively high. And you can, it might be a whole another topic for another podcast, but interesting to me that the last couple of years, at least in the province where I live in, I think this is more of a national story. Like there isn't a union out there that has not asked for a wage increase.
I don't think there's a person out there that hasn't asked for a wage increase.
Absolutely. And
I'm going to go ask right now.
Yes. Good time of year to make that ask. But I mean, like in BC, I'm just thinking off the top of my head, right? We had the nurses union, the teachers union, and the ferry workers union. I'm not going to comment on which of those.
Dock workers.
The dock workers also.
Poor people, yes.
I'm not gonna comment on whether those are deserved or not. I'm not an expert on whether they are, but those were the major ones, and obviously that creates a certain amount of inertia. As in, my best friend just got a new shiny car and a pay raise. I want the same thing, and so that I think creates some underlying stickiness, some structural stickiness to wages.
It also drives prices higher.
Absolutely, yeah.
Like someone needs to pay for those wages. That usually means higher prices or taxes or something.
Totally.
Prices equal inflation.
Totally.
That's not what we want.
I recently was in conversation with your colleague Robert Kapsick about your the BMO proprietary financial conditions model that you have, or financial conditions index. That's shown some signs of loosening up. Obviously, rate cuts are a big part of that. Credit spreads are a big part of that. Dollar Canada is a big part of that. Like there's a few things that go into it that are kind of pro-cyclical, but it's shown some loosening, and not a insignificant amount. So I've been spending a little bit of time like looking at surprise indexes across the board, and we should talk about this with the US data. But Canadian Surprise Index has not had much of a pop as of yet, but I think it's early days to watch that. I think just the last thing to talk about, Ben, is just the benefit, and I alluded to this when I was talking about terminal rate before, but the benefit that Canada gets, there's a lot of focus right now on tariffs and how much that's going to hurt our economy. But there's not a lot of focus on what the impulse from U.S. fiscal is going to do into our economy. And I think that's obviously a bigger topic for the U.S. and a huge differentiator between Canada and the U.S. And we should spend some time on that if we have time. But I do think U.S. fiscal is one of these things, like we still have a massive trading relationship with them.
Yep.
And, if U.S. fiscal stimulus, even if you say it's going to be all buy USA, if the new administration especially is going to say, right, everything is going to be made in the US, we are still going to get some impulse from that. I don't think it adds half a percentage point of growth. It's probably a bit lower than that. But when I've looked at this in the past, it was not insignificant, and it definitely isn't going to be a subtractor from GDP.
No, it could definitely be meaningful, I'd say. I mean, that's the knock-on effect of better U.S. growth to Canada is real. My concern is it's not what it used to be, and that's one of my worries about the Canadian dollar move. That the dollar is moving because productivity in Canada has been horrendous forever, and there's no effort here to fix that, and the government is not sufficiently occupied by this problem to really put a real effort into to create a lasting solution. And so the currency's been hit by that. On top of that, you have rate spreads, which is part of that productivity problem. And on top of that, you have the trade tariff threats from Trump also weighing on the currency. But my question would be more like, or my concern, I guess, more than a question, is like, well, if Canadian manufacturing was hollowed out by the currency moving through parity 12, 14 years ago, how much of a bounce are we going to get this time when the currency really weakens off the way that it has? How much of a growth booster is that really going to be compared to 25 or 30 years ago when Canada had a larger manufacturing base than it does now? So that concerns me. And that, like, the financial conditions index would have the currency in it, and so, but maybe it's not quite as stimulative as you think, which would not be good, because it would mean you need even weaker currency, which I don't want to see because I like going on vacation.
Yeah, absolutely. There's a lot to unpack there. So I think this might be a good segue into things. So U.S. Fiscal at our conference last year, there was a great panel with David Jacobson and Brian Tobin.
Yep.
And they made a great point that we like to, or our current leadership in Ottawa likes to say, we're running a 1.92% budget deficit. In the US, they're running a 6% budget deficit. Now, we like to look down and shake the dirty end of the stick and say, like, look how much more fiscally responsible we are. The point on that panel at our excellent Global Reserve and Asset Managers Conference was that the 6% is actually a more productive spend, because a lot of that's the CHIPS Act, the IRA. These are effectively fancy words for tech subsidies and tech investment. And you and I can argue whether NVIDIA making a super chip is going to actually improve productivity across the board or not, or whether it's just going to make someone's video game run faster and graphics cards work better.
I'm just waiting until I can plug it into my head, and then I move faster and am smarter.
We could, absolutely. I think I could use some of that on the West Coast as well, especially with our hours out there. But the Canada portion of the deficit, and you touched on this, is being used for consumption. So we hand out checks, and you and I both know that whether those checks are put with someone in the bottom quartile or the upper quartile, it's not going to be put into a productive assets generally. So yes, they're running a bigger deficit structurally, but you could argue that will pay off longer term for them.
Yeah, no, I totally agree.
And you could argue that the market's giving them rope to do it, right? Like there's no...
Not yet. There's no real issue yet.
There hasn't been a pushback, right? Like you could say maybe the one area where it's starting to become a little bit apparent that the market is taking a small concern about the fiscal situation in the U.S. is 30-year swap spreads in the U.S. That would be one area where you could say this is an area that it's worth watching, but it certainly hasn't affected business confidence. It certainly hasn't affected productivity. It certainly hasn't affected the dollar. I mean, I think everyone in the world knows the story about that. So you touched on productivity. I just thought that was an interesting point and kind of speaks to the differences across border, right?
I mean, that I recently, and for the first time in my life, and I can't remember if I did it on here last time or said it on here last time, had said publicly that I actually wouldn't mind more fiscal spending, wouldn't mind a slightly wider deficit. That is entirely contingent on the money being properly spent to improve Canadian productivity. So whether it is, I don't like subsidies, so I do not want that. But I think better tax policy, lower taxes on the business, personal side at the high end of things to incent people to work harder. That is what drives productivity. Incentives. Shocking, I know. But that's what we need. So like 6% is a lot. I don't think we should run a 6% deficit. If it was an extra percentage point, I wouldn't care all that much. I would say while the U.S. might benefit in the medium long term from some of those investments, I still worry about them running this deficit and having exactly zero appetite to trim things down. And there's not a lot of room to do it either. Like their discretionary spending is pretty light as a total. It's around 1.2 trillion, I believe. So let's say you cut that 20%. Great, 250 billion. That's like barely a drop in the bucket. You still got $1.5 trillion-ish to go. Where's that rest of the money going to come from? That's the hard part for me. And maybe the market one day says, no, you're not allowed to do this anymore. And then you have this massive U.S. fiscal drag. And that's one of my issues with Canada-U.S. spreads. Is that like I understand why the U.S. is cheap as it is because all those bonds, that's fine. But you do have this big fiscal overhang at some point that is coming. And so over the next 30 years, you're going to tell me it's not coming at all? Or is the reckoning going to come and then they're going to have to tighten up a ton? Yeah. And then growth will look way worse in the U.S. And Canada might smell like relative roses. I don't know.
The cleanest dirty shirt argument.
Yes.
I think it might be worth I wanted to circle back to your point around whether the currency this time around helps cushion some of the blow. Like it's supposed to be, I guess you're the macro expert here, but currencies are generally a stabilizer mechanism for the economy, right? In your macro 101 textbook.
Correct.
And the thing is, I think, and you and Doug have written a couple great pieces on this with our tax policy and our lack of competitiveness generally here. It's not clear to me that companies just all of a sudden say, oh, wow, look at dollar Canada's at 140 or 145 or 150. Let's go put a bunch of factories back in Canada. It could be that you have the weakening currency, which obviously has long-term effects on your business investment because we buy a lot of machinery and equipment from the US. We get a lot of intellectual property from the US and even Europe, right? There's still some we buy, but let's just focus on our biggest trading partner. And so the stabilizer mechanism is supposed to work. That's supposed to make it cheaper to produce goods in your country. And this time around, I worry that actually doesn't come back.
Yep.
And so we have like the worst of both worlds in that case. And obviously that's a major concern about the Canadian economy.
So one thing that I can't remember who mentioned it to me very recently. Man, I forget a lot of things. This is not good. They highlighted that where we might benefit more from a weaker currency is on the services trade side. And so would have been a few years ago. If you looked at the pay for, I think the FT had an article, the pay for tech workers in Canada versus the US. In Canada was much, much cheaper. And so if you were to push the currency that much further, you'd get more impetus from those companies to hire in Canada just on the back of a cheap Canadian dollar. The issue there is you don't really get any lasting impact. And unless you create some kind of tech cluster or some intellectual property that comes out of that, some of those people start companies in Canada, you don't get anything out of it. So you don't get the same longer term benefit on the productivity side, lasting investment. You don't get that. And so that I echo your concern there pretty meaningfully, unfortunately. Another challenge for Canada. Canada should rise to the occasion. Policymakers need to put their big boy pants on and understand that in order to compete with the U.S. and other global economies, you need to be better than they are, not just the same. So that means better tax policy. That means more efficient tax policy. That means more efficient government spending. Do your best to make your cities more efficient, improve traffic, improve standard of living, make people want to work here, make good people want to come to Canada, make smart people want to come and live and work in Canada. And that's not the way we run policy at the moment. We just kind of, not really sure how we do things.
This is just, as a proud Canadian, I'll just say this is a fantastic country to live in, but our policy from the top of the house is extremely reactive. Like everything you just said, we seem to react. Like even as recently as this trip to Mar-a-Lago, which is getting way too much press time, we are reactive. We don't take things seriously until they're at the forefront, and then we come up with reactive policies like the recent tax holiday buy vote package that's been floated out there.
You said it, I didn't. But no, I wouldn't even necessarily blame it entirely on this government. You can go back to prior governments, and the tax policy is generally not driven by what is most productive. There's been subsidies for decades on all sorts of different industries. Doesn't matter what they are. That is not the right type of policy. That's not how you advance productivity. That's not how you let the market choose what industries should succeed and what shouldn't. This is I mean, you can blame the current government, sure, but this is a long-standing problem, and that's one of the reasons why I've consistently said you want to revamp the entire tax code. This is not it's not a one-day project. This is a multi-month, multi-year, more likely than not, project that they should push forward. And let's touch on the Fed a bit. Change topics just for a second here, because I think it has a big impact on the Bank of Canada. When the bank went 50 in October, the Fed had just gone 50 in September. Since then, the Fed's gone 25, and the December meeting is looking like somewhat of it's priced as kind of like a toss-up, a little more skewed to 25. It looks like they'll go 25.
I had 17 for what it's worth. I glanced at it before I came in here, and it was 17. So
60+%.
Yeah.
So leaning toward a 25 BP move, which is fine. And it looks like looks that way unless you get a monster payroll number again. But if the Fed's going 25 and considering pausing in the relatively near future, should the bank be looking at going 50? Because once you go 50, unless you are somehow magically doing a hawkish 50 basis point cut, and I don't understand how those words come together, you're pricing at least 25 for the next meeting, and you might even be pricing like 40 or 30, well, 50-50, I guess, like 30 plus for the January meeting. And then the Fed might be pausing, and Canada-US spreads are, I don't know, 150.
You're making great points here. We should discuss the Fed and then Canada-US spreads, which is a topic near and dear to your heart and my heart, which may speak to our social lives. So we spend so much time on that. But the Fed, look, payrolls on Friday. I'm going to state the obvious. Payrolls on Friday are definitely going to matter. There should be some catch up from previous months' distortions. I think optics and inertia kind of combine to keep them at 25 basis points. They'll take it. I also think there's an element of politics there. You have an incoming administration. You are on a path to cut 25. You probably don't want to rock the boat. You're not bowing down to the new administration, but you're being consistent, which is probably something the Fed wants to show that they are, whoever was going to get in the White House for the next 4 years. Yeah, look, I absolutely think that the three pillars in the U.S. that are keeping that economy strong, we've talked at length about fiscal already, the jobs market there. You've seen a moderation. Unemployment rates tick up a small amount on the margin. Participation rate is just sticking around where it has been over the last little while, goes down 0.1, 0.2. Wages are staying relatively high. Then you have housing. That's kind of the third one. So you have U.S. fiscal, the job market, and housing. And housing is just kind of a technical setup there. So they've got similar supply problems to what we have in Canada. Mortgages, most people have mortgages. I think BMO Economics put out a great chart a while ago that most people, 90% of mortgage holders there are under 4% effective on mortgages. So, I think if you pull it up on Bloomberg right now or walk into your local bank there, you're probably getting something with a 6 handle.
Oh, yeah.
So, leverage is working. The price of your house is going up. There's a wealth effect there. There's a wealth effect from stocks. So job market hasn't cracked. Your government's spending money and your housing market and stock market are going up. It's kind of a nice cocktail to keep things moving in the right direction, and hence tempering where that neutral rate is from the Fed.
Okay.
So the Fed will cut 25. It's the path of least resistance. But the bank going 50 in that light, now that they kind of know the cadence of the U.S. and they've seen to use a poker term, the turn of the U.S. economy, the 50 seems out of place. It seems a little tone deaf, especially with some of the things we described around, well, the one thing we actually didn't describe around resilience in the Canadian economy is like the sort of signs of life or the green shoots in housing.
Yes.
And I know you and the team at BMO Economics have probably spent a little bit more time on that, but it's not like animal spirits have totally come back to that market.
Not quite. It's stabilized. It's perking up. And then the risk is of a much sharper increase at the turn of the year. When the mortgage insurance rules change, there is the potential for a fair amount of demand to just be unleashed pretty quickly, actually. So I don't even think it will be in the spring necessarily. It could be before that. It kind of depends on what the supply side looks like. But effectively, when you allow people to purchase more expensive houses with lower down payments, that generally means more demand. And the Bank of Canada has warned about this, so that's another reason for them to be a little bit more cautious for sure. One last point I'm going to make before I'm going to ask you for your favorite trade ideas, because we're running up on time here. The neutral rate. You mentioned the U.S. neutral rate being maybe slightly higher. One of the arguments that the 50 basis point camp likes to make is that they believe the Bank of Canada wants to get to neutral in a hurry. And so cutting 50 basis points would get you there faster. The bank they've published their neutral range. It is 2.25 to 3.25, 2.25% to 3.25%. That is their long-term neutral range, though. And they've noted that a number of times over the past few months. And one of the things that Governor Macklem said about 6 weeks ago or so is that we will discover the neutral rate as we go. And so cutting aggressively to a rate where you don't know where it is doesn't make a whole lot of sense, at least not to this guy. So why don't I leave it there? And Matt, what are your favorite trade ideas right now going into 2025? And this might be the last podcast of the year. I'm not sure yet. I haven't decided. But if it is, it effectively is your 2025 ideas. Otherwise, I'll do another one with all of my 2025 preview, but We'll see.
Okay. No,
no pressure.
No pressure, yeah. So I think one that you and I have talked about, and we've talked about this with clients, is fives on the curve. Mm-hmm. Unfortunately, I think it's become a bit more consensus. But if you believe in a combination of things, if you believe that the neutral rate is not as low as what's being priced in the market right now, if you believe that the housing market can pick up into the spring, you and I were discussing those charts recently on mortgage origination and its correlation with fives on the curve, with a bit of a lag, its correlation with 5-year swap spreads, that argues that if animal spirits do come back a little bit into the housing market, the neutral rate goes up a little bit. And, we didn't chat a lot about Canada, US, but if our neutral rate is getting fully priced to be 90 through the US, I looked at a chart today, and we've always, in cutting cycles, we've always ended sort of plus 25 to 50 versus the US. Mm-hmm. When it's all said and done. That's usually there's some technicals in there. They go to zero, and they have a range, and sometimes we have just an overnight rate. But generally, we end in the same spot, plus or minus 20 basis points, and usually we're higher than them on the overnight rate. So if you kind of take history, some of the technical factors that could come through in housing, and some of the resiliency in the data, also, and just what's priced, fives on the curve still have room to cheapen. They, on a yearly chart, they look like they've had a massive move. On a 5-year chart, they look like they have more room to run. I think Buckley mentioned them in one of his latest podcasts with you, so I don't think I'm saying anything too profound there. Canada US is another one, and there's a lot of the same logic that I just talked about for fives on the curve. There's two things on Canada US. We've talked about some of the reasons why it's here in terms of the fundamental data. Obviously, DS1, DS2 is a well-publicized phenomenon, and that a lot of money, coupon and maturity money, rolled into Canada. The tariffs aren't helping. I think one thing that hasn't been mentioned there is just positioning. And, we've done a little bit of work on some of the flows in futures there. And it's fairly obvious to us, at least, that the market has a short position on Canada US. It's in futures, which implies it's a leveraged position. And I think that explains a lot of why Canada has had a hard time selling off cross-market against the US, because some of the leverage money has maybe had this on, decides they're going to cut out of the trade. So a 5 basis point cross-market move, like we had 5 basis points becoming the norm cross-market on daily moves, have covered those positions. At the same time, when Canada gets stretched, and when it has, like into DS1, DS2, when it has a big move the other way where it tightens versus the US, like I think we got to negative 115. Mm-hmm. We've flirted in tens, we've flirted with negative 130 in longs. When it does tighten, there's not a lot of ammo to push back against that. And so, that's one of the technical factors that's keeping Canada rich. I do think that the divergence trade event does work. A lot of bad news is priced into Canada, but it may have one more technical flush out before we get there. So if you're thinking about doing Canada US, just be a little bit tactical with it.
I agree on both. So one on the fives on the curve. One thing I just note for very near term, if we get bank issuance, bank like Canadian bank issuance in the market. Tends to be in the fives, bridges that part of the curve. Might give you a good opportunity to get short fives on the curve. So
Yeah, that's
one, tactically, there's a good opportunity. Two, yes, I like being short Canada-US. In tens in particular, I wouldn't mind seeing a washout on positioning. I suspect the bigger move doesn't come until the new fiscal year. So April 1, or maybe in the lead up to that, when provincial issuance is really going to start to ramp up again, because they're in great shape now. Provincial spreads are tight now. They're going to stay tight for at least another couple months, but issuance is coming back. Make no mistake, they still need money next year, but it's not going to start till April. That's when it's going to come fast and furious again. And so at that point, Canada has probably a meaningful amount of room to cheapen up. The other thing I'll mention, and I'm sure I'll mention it again if you haven't already heard this from me, is 10s30s in Canada. It steepens almost always in January. Go back 20 years, I think it's steepened every time but 3 or 4. So I think 16 out of 20 perhaps, maybe 17. And it's pretty consistent there. And if you consider the levels that we're at, 5-ish, 6 basis points today, it is Wednesday afternoon, nearing 5 o'clock. You don't have a lot of downside. And so your risk reward's got to be 2 to 3 to 1. I mean, it can easily get into the teens. I don't think that's a high hurdle. 20 might be a little more challenging, but still looking at 2 to 1 risk reward. I think that's generally pretty good trade.
Maybe you get that on if the BOC ends up only doing the 25 and the 12 basis points gets kind of washed out of the front.
Even more attractive.
The curve flattens a little bit, then you probably have your opportunity to get that on next week.
I like it.
Yeah.
I like it. Matt, thanks for coming on the show.
Thanks
really
for having
appreciate
me,
it.
I can't wait to be back.
We'll have to fly you back in for the next time.
Thank you very much.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.